Hi, I'm David Scranton, and thank you for clicking this video because today we're talking about the markets. And yes, this year we've seen a soaring stock market. We've seen record high inflation as well as up and down interest rates. So what does all this mean for investors like you? Well, to answer that, let's bring in Jeff Small, president of Arbor Financial Services in Melbourne, Florida. Jeff, as usual, great to see you.
It's great to be back, Dave.
And also today's guest, Jon Najarian. He's co-founder of Market Rebellion, and he's also co-author of the book, Follow the Smart Money. Jon, it's so great to have you back here on The Income Generation.
Great to be back with The Income Generation. I love it. Thank you.
Jon, we're talking about stocks and the markets today. That's a huge topic because the market is so overvalued right now. And if we go back to Stock Investing 101, every investment is really the present value of all future cash flow. And I know you remember that. But for our audience's benefit, has the market lost sight of that because values are so high?
Absolutely. And I don't need to show you a better example than Rivian. And it's a stock, Jeff, that I bought, but it's an electric vehicle manufacturer. Of course, they're trucks, and it's a good-looking pickup truck. Everybody's tastes are different. The Lightning by Ford also looks lovely. I don't know so much about the Cybertruck over at Tesla, but Rivian has no sales, but they have a sexy product. They don't have a dealer network that's going to take most of the money from the sale of the vehicle, and they don't have the legacy costs. So people are definitely, Jeff, looking beyond the normal metrics for measuring what a company is worth and saying, well, the reason I can pay such an extraordinary PE, if there's not even any P yet for those earnings, is that the future revenue stream is going to be so great. This is the future, these electric vehicles. And so that's why you get a crazy valuation like that.
Well, they've always said, Jon, the market's irrational, but boy, that just takes the cake. I mean, talk about irrational. It makes no sense. $140 billion market cap on Rivian and no revenue yet. That's craziness.
Yep. But, it's a brave new world, and we're just lucky to be living in it, I guess.
But Jon, if you get out of that sector of electric vehicles, do you feel like in many of the other parts of the market that market participants are suffering from that dreaded word FOMO, fear of missing out? Or do you think that things are still relatively rational in other areas?
Well, it's a great question because you've got a stock like Apple, and there's clearly not a FOMO in Apple right now because it is actually one of the underperformers on the year, even though it's over 150 a share. It's made money this year, a lot of money. But it's not one of those stocks that's just zoomed to the upside, like, for instance, some of the cybersecurity stocks, some of the software companies that have come out that have just crazy FOMO. But when that fever breaks, it breaks hard. Just look at Snowflake, SNOW. When that one broke, it cut the valuation, dramatically. And so I would always, as you guys would, caution investors about trying to steer themselves away from that fear of missing out and instead make that a very small part of your portfolio, not a very big part.
Sure, and it's funny, you and we both agreed toward the beginning of this year that there'd probably be a good solid 10 or 15% pullback before the end of the year, which would give us a buying opportunity. And of course, September, I was getting excited thinking, oh, this is it, this is great. We didn't really get to that 10 or 15%. Things took off again. So is that the best buying opportunity we're going to see year to date or between now and the end of the year, do you think?
I think so, although there are a number of stocks that will start seeing that tax loss selling. And as you guys know, it's no longer T+3 for that, meaning that it has to settle before you get to recognize the loss. There are a lot of stocks that will be sold into year end so that people can match up some of those losses with some of the big gains they've got this year. So depending on how big a wave that particular tax loss selling is, you could see a sector or two really come under some heavy pressure. But for an awful lot of the other sectors like energy, that's just been like this, or banks that have also been like that. I think you're wise to hold on through the year. I don't think you get that 10 or 15% correction from here through December.
So, John, has the Fed gotten it wrong? Because now they're tapering. There is a correlation between when the Fed stimulates and the markets rising and asset prices rising. I thought they were kind of aggressive. I don't see them raising rates next year, but have they gotten it wrong at this stage since we have really 2% less workers than we did pre-COVID today with all of the stimulus?
Yeah, I do think they've got some of it wrong. They said they wanted to let inflation run hot for longer. They have done just that, Jeff. So I'm not surprised that we're seeing a 6% inflation at the consumer level and a pretty high level at the producer price as well. I think that means that they're behind the eight ball. So I don't think it's going to be nearly as transitory as they thought. And we still, to your point, do not have a lot of workers back. To get them back, you're going to have to see a significant wage inflation. We've talked about that great resignation. And an awful lot of folks have just said, you know what, I'm not working for that money anymore. I've kind of discovered that if I budget and stay home and live off unemployment, I can do that and have a better life than spending an hour each way commuting and then paying a significant portion of what I earn to the government. So I think I'll just stay at home. To get those people off of that model, you're going to have to see significant wage inflation. And that's why I say it's not transient or transitory. This is going to be something that's with us well through 2023, maybe all the way to 2024.
John, are you seeing signs of stagflation out there? I mean, I'm starting to feel to some degree like it's a little bit like the 1970s again, except that, you know, I could imagine that it's going to be this long, but I'm starting to see some stagflation, which is never good.
You could see that if the Fed really gets aggressive now, for a host of reasons, Dave, not the least of which is, of course, we've piled on the debt, both under President Trump and now under President Biden. He's accelerated that debt. We have to pay that back. And obviously, we never really pay it back. Instead, we just pay the interest, which is what those bonds are. That's the interest on the debt. And I think that just, if they start moving rates up too fast, that will cause that stagflation that you're talking about. Right now, we're just talking about taper. So if Jeff's right and we don't see a move to increase rates in 2022, that'll be a good thing, because there's obviously a lot of liquidity that is brought just by the Fed buying bonds. And when they taper, they're buying fewer and fewer bonds as they taper. If all of a sudden they go to an interest rate increase, I think that's when you get that stagflation. And that's what many of us hope does not happen.
Yeah, you've been around long enough to know that in the past, the Fed has often been both the arsonist and the fireman. They get to take credit for putting the fire up, but a lot of times the missed timing is what actually caused it. Of course, that's easy for us to say from the cheap seats, right? So you mentioned this national debt, and of course, therefore the concern that taxes are going to go up dramatically, especially if they get the next 2.5 or 3 trillion approved. So how much of a negative effect do you think that will really have on the stock market over the next 2 or 3 years?
I'm certainly hoping that we do not get that very, very significant 2 trillion or 2.5 trillion. They're talking right now about 175. They're not going to pay for it with what they've talked about, guys. You know that. I know that. We can do basic math. That's why they were coming up with ludicrous ideas like, what if we tax billionaires or people centimillionaires and so forth on unrealized gains? In other words, you haven't sold that stock, but it's gained a significant value over time. We want to tax you on the gain there. Again, those kind of games, that would be terrible for the stock market. It would be terrible for individuals. And so I'm hoping they pare this back significantly. Yeah. And hopefully it's a lot closer to 1 trillion if it even passes. And keep in mind, that's over a decade. So I think we could handle that amount of additional debt and the interest payments on 100 billion a year. But if it gets into the 300-400 billion a year, I don't know how we do that.
That's a lot. John, real quick, 2022, positive year or negative year for the S&P 500? What's your best crystal ball say?
Negative.
Negative year.
The end of the year, negative, because interest rates and energy prices, which are just going whoop, 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 are going to be things that are a drag on the economy, and that'll have to be passed on to the consumer. We're already seeing it. It's going to be worse next year, I think. But that doesn't mean I'm looking for a huge drop, maybe 12% next year.
Yeah.
So you'll have to be nimble.
Yeah. And if you're retired or close to retirement, you're counting on that money. Keep one finger on the trigger, but it doesn't necessarily mean to get out of the game today. Jon Najarian, Jeff Small, as usual, my pleasure. Thanks for being here on The Income Generation.
Thank you, guys.
Thanks, Dave.
Thanks for watching today's market update video. If you enjoyed it, please click the thumbs up button, give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.